guys, Voz here, and I'm in my car because, hey, I'm always on the go, and I know you guys are always on the go too. Busy. But that's why tonight at 7 p.m., we're going to slow it down and have a little party to describe to you what Trade the Close is all about. What happens when those VIP doors close at 3:30 to 4? You'll find out. Bombshell trades, kinetically confirmed trades. I'm going to tell you the who, the what, the why, and of course, you need to obviously be part of this club. I want you guys in it. So be there, find out what it's all about. I'll prove it to you, and we'll see you tonight at 7 p.m. Plus, because I love ya, I'm going to give you a VIP watch list because that's what Voz is all about. See you at 7.
Confirmed. Voz was parked while recording that. Don't worry. Also, she has nice leather seats in her car, but Tom Gentile is coming in right now. I hope you all hang out with Voz tonight. But now it's Tom's turn with Power Profit Trades. Bring him in 5, 4, 3, 2.
Hey guys, welcome to Power Profit Trades, Operation Surge Strike Edition. It is Tuesday, June 7th, 2022. Hello, all of you that are hanging out here with me at Monday Morning Live, and of course, YouTube. Got the YouTube group in the house as well. You are looking at me, the top trader in the Operations Surge Strike strategy. Oh, wow. And for those of you that don't know what Operation Surge Strike is, it's a system. It is a rules-based trading system that we use to capitalize on expensive volatility, actually volatility getting more expensive. This is a long vol strategy is what we call this. Sometimes we use calls, sometimes we use puts, sometimes we use straddles. And I'm going to talk about all three. So any of you who are not familiar with it, this particular rules-based trading strategy kind of surrounds itself around one scan that we use, and we call it codename Brutus. I want to talk about Brutus. I want to talk about how we use it. I want to talk about risk off, why we went risk off this week. Okay. What is risk off? I also want to talk about what I'm seeing coming up as some extraordinary candidates that are going to pull us back in the party. All right. The IV party. So let's go ahead and get started. Eric, hey, man, I haven't seen you in over a week. What's been happening?
Well, we missed you yesterday, but it was nice to hang out with Joe here in the main room. You know, we're keeping busy over here. I'm excited about what you have to talk about today on the show, kind of breaking it down a little bit more for some people that may not have an understanding. How are you?
Hey, you know me. I'm like one of those lizards. You know, the ones that got the lizards where the eyes are going like this.
Chameleons,
so I'm always
yeah.
doing one thing at a time.
Yep.
My wife says I have the worst ADD in the world. Because I really do. Multiple screens were made for guys like me, and some of you that are watching this, you probably feeling me on this one right now. So, speaking of multiple screens, Eric, let's go ahead and move over to one of my screens, and let's check out some of the key levels that are happening. I haven't talked about this in a while, and so big red mouse is on the screen. The only thing I want to do to this particular chart is I want to add Fibonacci in here. I haven't talked about Fibonacci in quite some time. So before we get started, let me just give a quick shout out to everybody. And I want to ask a question to the room. Big Cap says, I look rested. I got to tell you, Big Cap, I got the most sleep last night that I've probably had in about 2 weeks. So I'm feeling pretty good. The lizard eyes are definitely going. Guys, very, very quickly here. Who in the room needs a little refresher on Fibonacci? Who in the room needs a refresher on Fibonacci? Does Nick Black need a refresher on Fibonacci? I see him in the room. I talk to him. He doesn't talk to me. I see him on text. But anyway, guys, so I got a lot of me's. Yes, me. Let's do that. Let's talk about some Fibo. Or some Fibonacci. All right, so what you're looking at here, I got a lot on the screen. Let me just get rid of a couple of things here, Eric, because, first of all, we could pull the moving averages off. Let's just do a reset. There, that's enough right there. I got 3 things you need to be looking on this screen at right now. Number 1, the candlestick chart. This is the actual chart of what we're looking at in question, and right now it's the S&P 500. Number 2, the red line. This is what option traders look at. It gives us an idea whether options on the underlying asset are cheap or expensive relative to where they've been. What we do is we take a snapshot each day of at the money calls and at the money puts, or near money calls, near money puts, and then we use that that powerful formula. Okay, the one that got the Nobel Prize, that Nobel Prize winning formula to determine what we call the IV percentage, the implied volatility percentage, based on a particular time frame. So what we're doing is we're looking at the near money options, the ones that are 7 to 30 days. Those are what I like to call the procrastinator options. That's the ones that most people trade. And so we look at that and we measure these. So when we're down here, this red line tells me that options are relatively cheap. And when we're up on the high side, they've gotten expensive. Now, what you might also notice is that when we go up in implied volatility, a lot of times we're going down in price. And that is true with most of the indices and even stocks out there. So you see the S&P how it rises from, let's call it about beginning of March to the beginning of April. We had this nice rise. And option traders kind of calmed down. Volatility got calm. All right. Where's that? Nick has that. No, it's not Nick. It's Kenny. Kenny has that little bowl he likes to. I got one of those bowls. Actually, it's my wife's. All right. We got the bowl. And so that's what's happening right here. As volatility is dropping, people are getting calm. And then all of a sudden, the market starts to drop again, and everybody goes crazy, and vol goes up. Now, the other way you can measure this volatility is I got stock price on the left. I've got volatility on the right. So when volatility goes from a 14 to a 32, that is more than double, okay? That volatility more than double in value, so expect your options to be priced twice as much, all right, here as they were here. That's the way we look at that red line. Where are we at right now? We're right in the middle. We're in the Goldilocks era of options implied volatility. Okay. Okay. I got to stop looking at these text messages. I'm looking at Big Cat. Eric, do you see that? He fills the bowl with 420.
Yeah, I see him. Big
You know what I
Cat's
fill
always
the
got
bowl with? 5 o'clock. Because it's 5 o'clock somewhere. All right. Although I've been doing a little more kombucha tea than I have anything else. I like that kombucha tea. All right. So here you go. So we've seen volatility drop. It's dropped from the high side a couple weeks ago into the Goldilocks era. Not too cheap, not too expensive. So we could do a lot of different option strategies right in this area here. All right, last thing I want to mention is you're looking at the blue lines. Now, I have some dotted blue lines on here. These are things that we look at right on our software. It looks at different areas of support and resistance throughout the chart. And then I've got the solid blue. The solid blue are Fibonacci lines. So what you're seeing here is you see a Fibonacci starting point from back at the beginning of the year. And you see that line going down. That means the trend is down. So what we're looking for is when you're in a downtrend, and we're in a downtrend right now, what we're looking for are resistance areas. We got resistance at 423.13 on the S&P. We have a 50% retracement. That's a resistance retracement of 433 and a 61 at 443. So bang, bang, bang. They're all threes this time. Now, what's going on with the markets this week? All right, we're seeing a little bit of consolidation because, again, all the eyes are going where, everyone? Do I even need to say it? What's happening sometime tomorrow? What's happening that could cause this little area here? Let me zoom in on it. These last 7 days to break out above the weekly high or break down below the weekly low. Here we go. Yes. Fed meetings. Okay. And L11, no, it's not the Dallas Cowboy cheerleader tryouts. Although they probably could do better with monetary policy than the Fed at times. So you got a Fed meeting that's coming out that is more than likely going to break this thing above or below. So the question that I look at is, did we have resistance hit last week with this weekly high? Or are we going to get a Fed response that's going to pop the market for a day and get us up into the 423 area or maybe 433 area only to hit resistance hard and start to drop back again. I think almost either case means either drop and drop or pop and drop. That's what we're seeing right now when you look at everything on the screen. This is the S&P. I'm going to move a little faster now for everyone. So if we go to the next chart, which is QQQ, a lot of the same. You've got the downtrend that started before the beginning of the year. We have the low that came in about 2 weeks ago. We've had a bit of a bounce, but we've got resistance once again. You've got Fibonacci retracements at 331, 345, and 359 on the Qs, right? And I like to call this area, right now we're in the red zone. The yellow zone is 38% to 61%, and then the green zone is above 61%, which tells me that we're likely to be heading into a new bull market for that particular asset. Right now, we're dead red. That's what we see on the screen, okay? That's the Qs. Next, an implied volatility on the Qs. It's in the sweet spot. Now, let's turn to one more, which is the IWM. This is the Russell, and the same thing. All three, even though they have a different mix, a different class of stocks, all three start on the high side at the beginning of the year, ended on the low side between 2 and 3 weeks ago, or getting the bounce. Check this out. Check this out. Now, the IWM, the Russell, is closer to its area of resistance, the 38.2% resistance, coming up upon that right now. I find it's very interesting that you have both these resistance levels we're getting close to them right around a Fed meeting. It's going to be very interesting to see what happens. Not even tomorrow. What really happens on Thursday is what I'm more interested in. Tomorrow, we're going to get movement. We're going to get that Geiger counter movement that occurs. It's been occurring right after the Fed meeting. It's Thursday. It's the day after that makes the most sense to me. Bond market. Well, what can we say about the bond market? It peaked. It really peaked at the end of last year. We came down and hit a bottom back at the beginning of May. Here we are in the beginning of June, and we just touched off that bottom just yesterday. All right. This trend, I don't think this is, we're down here so far in the red zone. Bonds look to keep moving lower, which again, bonds moving lower, that means what? That means that we most likely are going to see lower lows in the stock market. And what gets dragged along with that? Well, if you're looking at cryptocurrency recently, Bitcoin and Ethereum are definitely in the Geiger counter zone right now, okay? I've seen Bitcoin go 29 to almost 31, back to 29, almost back to 31. It's trying its best to decouple itself from the stock market, but I don't think we're quite out of there yet. If we see new lows in the stock market, we're more than likely going to see new lows in the big cryptocurrencies. Okay, let's move on. Cash. Well, cash came down and got very close to our 38% resistance. I mean, it was on a rocket ship, and we did pull back almost as fast as we went up. Literally, we pulled back faster. We pulled back faster than we pulled up. But now we're seeing a little bit of bounce, which would make sense because if the bond market keeps going lower, folks, UUP is likely to go higher. USO is the outlier right now. You take a look at oil. Oil is back up to around 89.90. What did I say about oil, folks? What have I been saying about this one? Number one, hottest commodity. We're in a pattern, all right? I'm not looking at oil because of the fundamentals. I'm not looking at oil because the folks that were stuck indoors and that did not want to get out are finally pent up. Their pent-up demand is killing them. They're getting out. Middle seats are being, people are stacked on top of each other at airports. Flights are being canceled because either they're overbooked. Some people just aren't able to get on the flight, or the flight in total is being canceled for some reason. Airports seem to be just busier than I've seen in years, even pre-COVID. If you take a look overseas, you know right away that what's going on in Russia and Ukraine is having an effect on oil, gas products, etc. And so, if you look at, and I don't want to get political, Eric, I think you're on board with me. We don't do a lot of political stuff here. I don't knock the right. I don't knock the left. I'm a trader. I try to find opportunity no matter who's in office, no matter who owns what wing or what branch. But I got to say, when you look at this, I mean, what more could go wrong in the last year and a half for the current administration? I mean, let's go through it. I mean, COVID was supposed to go away. It didn't. We were supposed to return to some sort of normalcy. We haven't. And again, you could look at the news all day long. All of you here in the room, all of you could look at the news all day long. In fact, I find turning off the news is actually a refreshing thing. But you know what you can't turn off? You and I, all of you in the room, whether you're here at Monday Morning Live, whether you're here at YouTube, we cannot turn off what happens in the markets. And the markets do really precede news. If you're a true technical trader, then you know that technicals precede news. Technicals precede both private company news and even public and government news. You look at this chart of oil, and I'm telling you, I mean, this thing keeps going higher. All it's going to do is going to push prices at the pump even higher still. We're sitting on an area right now where I expect we could see a big explosion in USO up to that $100 mark. That $100 mark could come, and we could see what happened back here in February, this area here. I mean, just take a look. You got that bounce up, bounce back, bounce up, bounce back, up, back, up, back, up, back, and finally started to crest through that, and we got through the area of resistance that was around 82. What was it? Not maybe 2 weeks ago. Now we're sitting up at 89, and we got above the high here in the last couple of days that was around 88.5, right? And so there you go. You've got USO moving in the wrong direction for consumers, in the right direction for all of us. Okay. All right. So that's USO. Now let's take a look at that one that is it's even stumping me. Okay. As a pattern trader, and I won't see a pattern right now in gold until we hit August. So there is no real pattern happening right now. But I'll see a pattern come August. Here you go. Here's gold. We saw that the 160s all the way to 190, 151, and then back down. And we started to do the breakdown. And we broke down almost down to 100% on the fib level. See the fib level? 100% down, 166.15. 100% up, 190, 151. And take a look what's happening. We almost came all the way down. We're doing a little bit of a move here. But again, you look at this, and this is almost a complete pullback. I would have to go back and look at this a different way. Let me show you what I'm talking about. I'm going to bring up a brand new chart, Eric. We're going to go sideways here. All right. So let me log in again. Let me go ahead and go to stocks, my charts, my stock charts again. And what I want to do is I want to take GLD, and I don't want to look at it going all the way back into January. I want to look at it from March. So I'm going to cut this in half. So instead of 120 days, actually let's go 75. That'll do it. 75 will do it. There's that high. There's that high, and there's that low. And now I'm going to fib level this, and we're going to update it one more time. That's what I'm looking for. So what I'm looking for is, where is the resistance in this mystery of a precious metal GLD? There you go. So you got 177.47. That's the area where I see resistance to. So if we are going to move higher, and you get these little, it's like GLD's in a coma right now, and it's trying to come out of its coma. And it tried it at the end of May, and it tried it last week in June, and it's kind of slipping back into that coma. But the real resistance levels, folks, because there isn't any right now, is 177.47, 180.15, 182.83, and then maybe we get back in the green zone. But I don't see it happening in at least the next 30 days. Okay, so that's GLD. Let's get back over to our regular charts, and let's take a look at the last one of the overview, and that is VXX. This is the only thing of everything I'm looking at, the only thing that gives the stock market some kind of hope right now is that the VIX is slowing down. But how many of you know the adage, when the VIX is high, it's time to buy. When the VIX is low, it's time to go. So what that means, for those of you that don't know, is when the VIX is high, it's time to buy. That means is that when you see the VIX making these astronomical levels, it means that panic has set in and people are just selling stuff at any price, right? And that a bounce is coming, and that's what we've seen in the market. But now the VIX is low. I've got the VXX. This is the VIX futures. Where we're at right now is around just below 22. The low that we've seen for the year is at 1763. We could see this drop down even lower and set up for that potential next move to the downside. All right. So that in a nutshell is stocks, bonds, currencies, commodities, etc. When I take a look, Deja QQQ is asking if USO is a surge strike trade. It's not. And that's a great question, by the way. That's a fantastic question. So the reason why USO is not a surge strike trade is because we don't have events that are pre-planned. USO doesn't have earnings announcements. All right. So we don't know when the wheel, righty tighty, lefty loosey. That's the thing that the Saudis do. That OPEC does, where it'll tighten up supply or loosen supply. We don't know when that's going to happen. They don't prompt us for that. Okay, it's not like an earnings event for oil. So oil and indices themselves are not surge strike. But I will tell you what USO does do. Okay, I don't even think it's a U.S. holiday event, L11. What I do look at with oil is a longer term event. So maybe and maybe you don't know that between mid-February and mid-July is the seasonal bull for oil and gas. And boy, has it really worked out this year between mid-February and mid-July. What happens is the market preempts that surge, I'll call it a surge, of people heading to the pumps, right? That demand on gas, oil and gas, as we head into the summer. Now, the only difference between now and the last 15 years, which I believe it's about a 75% accuracy when you go back 15, 20 years. So the issue at hand is the price of gas and the price of oil right now. And because this is a necessity, this is not oil and gas are not some kind of discretionary, like, do I need a new sweater, or, oh boy, it's summertime, I need that new swimsuit, etc. Oil and gas I need oil and gas to get to my job. That's what most people, not just even Americans, but most people need gas. It's kind of like gas is up there with, food, water, air, gas. I mean, if you want to put it on the chain of I need it. I need air to breathe. I need food and water in order to survive. I probably need to have myself clothed, especially if I live in a really, really cold climate part of the year. And if I'm going to use the talents that I have, especially if I work for Tesla, I'm going to need to go to the office, Eric. And if I got to go to the office and I don't have a Tesla to get me there, I'm going to have some sort of combustible car to get me to the office. I'd be curious, Eric.
Yes, Tom.
I wonder at the parking lot at Tesla, how many cars, when these people pull up for their jobs, are combustible engines? I mean, a lot of these people can't afford Teslas.
What, Tesla doesn't give a free vehicle to every employee?
I don't think so.
They should. No, I would assume a lot.
And L11 is talking about the dirty little secret around electricity. Where does electricity come from? It's not this magic stuff that comes out of the sky. My wife and I were talking about this last night. She says, hey, I heard that we might have brownouts coming. And I think Florida, the first thing it says, oh, that's California. That's the West Coast. But then I started thinking, all these people moving to Florida, I wonder if the grid in Florida is even able to handle all the additional people coming in. So, and then that brought up, where does electricity come from? And, it's not, and I'm not saying that like my wife's asking me a stupid question. Where does electricity come from? Because she knows. But I mean, she said, well, but she's saying, she goes, do you think with all these people that are driving electric vehicles now, that's also putting in a hurting on the supply? And the answer is yes. And so many people think electricity just, magically comes from the sky. And it does by form of solar power, but solar power amounts for such a small amount With solar, wind, water, and then guess what's really up there on top? And L11 said it, fossil fuels, coal. So, and that's a whole area we could go sideways in, but I don't want to get down that road. But I'm basically talking about, what are the elements that are causing the price of fossil fuels to go higher? Okay, so I've been on this horse, I think, a little too much, Eric. I think we can all agree on that.
All right, Tom.
So let's go ahead and talk about some profits. Let's talk about how to hedge those high gas prices and how to hedge those high food prices. Because one way to do that is to be in oil and gas and be in foodstuffs. But there's another place you can be too, and that's where all the volatility is and where that volatility is rising. Now, I got to say, Eric, for the first week this month and all first weeks during the year, I haven't had a first week during the year where we haven't had a trade on Surge Strike, but we did this week. All right, we did. Well, yeah, this week / last week is that, our portfolio is clean right now. And so let's put up that little caption I put out to our members last Friday.
Sure, I got you covered here. This came out last Friday, June 3rd, Operation Surge Strike Alert. This is what came through the email. A big part of trading successfully is to know when not to trade. We hear Kenny say all this all the time as well. This is the first week all year in which we won't have a new trade in Operation Surge Strike. The market is skittish and could move sharply against any directional trade at any time, making picking direction extra risky. Straddles are the strategy du jour and have been working very well for us lately, but there simply aren't any on deck for this week. That said, we have 2 exceptional straddles that I'm planning for next week, Tom.
We do. And so, of course, obviously those go to our subscribers. 16-0, 16 in a row, not 16-0, 16 in a row before we hit our first loss. And so I want to talk about a little bit to everybody in the room why this strategy has worked so well this year, and more importantly, why I think that next quarter is going to be even better. And it has a lot to do with the volatility. 2 exceptional straddles we're looking at right now. Let's talk about what makes a straddle exceptional, because a straddle it's a bi-directional trade. Okay. It means I don't care whether the market gets bullish or bearish. What I care about is the underlying implied volatility, and what I like to call outsized surges. And so, Eric, let's throw that scan up on the screen with those 2 exceptional straddles.
There you are.
And you're going to see everything you need to know about these exceptional straddles on the screen, except what they are. All right, let me talk about them. So if you take a look at all the columns, these are things that we get from Brutus. Brutus serves up this data to me, all right, and some of our subscribers who have opted to go all in, go lifetime, and we're kicking in a year of Brutus for them. So, we serve up Brutus 2 ways, Eric. We have the Brutus trading strategy and the scans that you see right here. And then we also have a more streamlined version of Brutus, which is on an app that you get on your iPhone or on an Android device. Now, the app is very simple. It just highlights the stocks that we see and the entry and exit dates. It doesn't give you all the stuff that the software does. I'm showing you what we look at with the software. So we can look at things like wins and losses. We can look at what we call buy. When is the time to buy? So we had a buy before on 6/7, and we had, and that's or buy date before earnings. So we have the buy date of today, and we also have one coming up in a couple of days. Now, what's next is the calendar days, the number of calendar days, and a calendar day includes Saturdays, Sundays, and holidays. So calendar days before earnings. All right, you can see pick number 1 there has 16 days before its calendar earnings, and then pick number 2 has 7 days before its calendar earnings. So then we've got information to look at, like the exit date, exactly when are the earnings, and AMC and BMO basically mean after market close, that's AMC, before market open, that's BMO. Then we have the earnings date there. We have a win percentage, and what we do is we go back and scan these. We can scan these up to 8 to 10 number of earnings in the past if we have all the data that we want. Now, we do different passes. So Brutus will give us what we call a first pass. And I'm going to show you guys what a first pass looks like on just calls and puts later in the program. But first pass, then what we do is we go in and optimize that. And that gives us an optimized list of what we're looking at in the market. So from there, the most important thing on the screen I highlighted, Eric, and that is called the average IV change percentage. So if you go back so Eric, what I want you to do is I want you to put my screen back up, and then we're going to go back to that asset again. So let me put SPY on. So here you go. So when we see the S&P, let's just go 60 days. Let's just widen this out. There we go. So when you're looking at the S&P and you see down here, the S&P was at a 14. And then up here, the S&P was at like a 32. Well, 14 and 14 is 28. So, really, yeah, 14 and 14 is 28. So we could safely say that between the bottom back here in April and the top that actually came around the first week of May, we more than doubled the implied volatility, right? We just made a little bit more than double in implied volatility on the S&P 500. Now, Eric, put that image back on the screen with the hot, there you go. So take a look at our first pick. So that first pick shows that the average implied volatility has gone up in value over 153% between, all right, our buy dates and sell dates. And now our buy dates and sell dates on these are roughly 1 to 2 weeks. Sometimes we're in them a little longer. Sometimes we've been in them for only 24 hours. But what this does is it optimizes this date, and it tells us what the IV change, how that happens. Now, if you could remember the S&P, the chart that I just showed you, that happened in about 6 weeks. These happen in less than 2 weeks, all right? And in a lot of times, around 7 days. So we see that happening. And again, with the S&P, remember the implied volatility rose as stocks fell. So the only way you would made money on the S&P is buying puts. If you would have happened to buy them, at the IV lows in April and sold them in IV highs in May, you would have had an IV effect that was a double. This asset, what you're seeing here, the 153%, 156%, that's IV change regardless of where the market goes. That's the important thing. Now, the next most important thing we look at, I've got average theta. That tells me what's happening with time decay. Now, typically with options, that's a minus. We see time decay dropping most of the time on most stocks. But on certain stocks at certain times, do you know that time decay actually goes up when you're long an option? I know it doesn't sound logical. But hey, when have the markets actually been logical, especially this year? So that IV change tells us that theta is our friend for a short amount of time as an option buyer. And delta effect just tells us how much the stock moved and how much of that movement was part of the profit. Now, the last part is our average return on investment. What have we seen in the past? 172% or that ROI. That was on our first straddle pick, and 65% on our second straddle pick. So those were the pieces I wanted to talk about here. But some of you in the room are new to straddles. Who's new to straddles in here? If you're with me on Monday Morning Live and you have never traded a straddle before, now's the time for you to speak up and tell me if you've never traded a straddle before. If you're on YouTube, and I see you on YouTube, and you've never traded a straddle before, Kaylee, have you traded a straddle before? Hello to you too.
There's a lot of people who have never traded straddles coming through in the chat.
Okay. And you know what? I get it. I mean, you know what? You're here at this 11:30 to 12:30 segment with me, and I'm here most of the time. I try to be here all the time. If I'm not here, guys, I'm either traveling or I've got something it's a family thing going on that is keeping me from you. But I'm telling you, the majority of the time, I am here Monday, Tuesday, Wednesday. And if you've never traded a straddle before, I know that part of you are here because you're brand new and you want to know how the inner workings of this. So we did 16 winners in a row with Operation Surge Strike, and a lot of them were straddles. And a lot of you are saying, what the heck is a straddle? Anyway, a straddle, in its most basic sense, is buying an at-the-money call and an at-the-money put at the same time on the same stock, using the same strike price and the same expiration date. And what you're doing is you're trying to put a trade on regardless of where the market goes. Now, the problem with straddles are, A, they're going to be the most expensive trade in the entire bunch of option strategies. And B, if you don't know how to trade them correctly, it's like a death by 1,000 cuts. What I mean by that is every day time value could cut away from you. Now, how do we avoid that? We avoid that by, number one, putting straddles on at the right time. And the right time is when we're heading into an event, a trigger event, where all of a sudden everybody's pent up, and they got to get that Microsoft call, or they got to get that Apple put. You got all these people going in trying to figure out which way the earnings are likely to take the stock, and they're bidding up the option prices on both sides. And we see that with implied volatility. So I want to show everybody, Eric, how a straddle gets put into the market. So I'm going to use an example. All right. This example is not, well, you know what? This example is coming up with Operation Surge Strike. It's just not today. It's not for a couple weeks. But we're going to revisit this one in a couple weeks and see if Brutus really likes it. Brutus, it's on the first pass right now. In fact, let me show you where it is. Here's optimal call put, and there's Micron Technology right there. It's on the first pass. And what I'm looking at is when we come across the screen here, when I see it on the first pass, it says, all right, I've got a potential entry date of 623. I've got a potential exit date of 630. And this hasn't even been optimized, guys. First pass is, think about if you're scouting, if it's opening day and you're the head coach of the football team and you've got all the rookies and you got all the veterans in and you got them running drills. You know what you got to do? What's the most important thing you have to do when you're a coach and you got everybody there? You have to do what before opening day, before the first game? What do you need to do? Tell me. I mean, I know not everybody knows this answer, but I know some of you do. There you go, Kathy. You got it. First one that rang in. You got to cut people. You got to go through. You run drills. You see every aspect of what each person can do, and you say, where do you fit best on my team? And then all the others, you got to cut them. You don't cut them all at once. You don't take your team and cut it all the way down to what you need all at once. You cut them through attrition, okay? So we may cut Micron, but right now Micron's on the first. We're at opening day right now. This is opening day on Brutus for the next month, and I see 9 trades, and I see 6 call option trades, and I see 3 put option trades. I don't have any looked at straddles yet, but let's say we look at Micron, and that's our example for today, and I decide I run the optimal on this, and it says, hey, Micron's a better straddle than it is a call or a put. All right, well, what I want to do is I want to place a straddle. So let's say I go look and I say, all right, Micron looks good, and again, I'm going to try to intertwine some of this with you. So we know earnings are coming out on Micron on the 30th. Now, the one thing that you want to do is if you want to be a volatility trader, you need to put your options expiration date just past the event. Because if you put it before the event, then it's not going to get the benefit of that IV rise. That IV rise, guys, that happens, you could even do it the day of the event or after, but never before, because it doesn't get, you're not taking advantage of volatility, okay? It might look cheaper, but trust me, just because something's cheaper doesn't mean it's good. Keep that in mind, right? So now let's say that I'm looking at this, I'm thinking, all right, what comes after June 30th? Well, July. All right. So let me look at Micron, and I'm going to put in straddle. That's going to set me up for the straddle. Now I see the what's after 6:30? Ha ha, July 1st. The day after 6:30 is July 1st. Let's look and let's see what we're doing here. The 70, let's look at the 70 call and let's look at the 70 put. Yeah, okay. So if I were to do a 70 straddle, this is what I'm looking at, folks. I'm buying both the call and the put together. So what's the call going to cost me? Right down the middle of the track, it looks like 360. What's the put going to cost me? The 70 put's going to cost 390. So, if I buy to open one of the July 1st 70 calls, and I'm thinking to myself, all right, 360. All right, let me take my $1,200 calculator, which, by the way, Eric, can you see this? What do you see on the back of my phone?
It looks like you broke it, Tom. What happened there?
Yeah. I dropped it coming in the house at night. And I got to tell you, my wife and my daughter have dropped more phones than you can shake a stick at. And you see, it doesn't have a protector on it either. I always have protection. I'm an option trader. I have protection on my laptop, but not today because I broke it. And I'm evaluating it. It looks like I got to go to the Apple store. I mean, I'm thinking I want to hold out till September, till the new one comes out. Maybe it'll hold out. But anyway, oh, I know why I went there. See, that ADD is kicking in again. So I want to use the very expensive calculator, the $1,200 calculator I talk about. And what I'm going to do is I'm going to do some simple addition. I'm going to take 360 plus 390. So 360 plus 390, that's the call plus the put equals. So I'm going to be paying $7.50 for this thing. I'm going to punch in 7.5 if I want to own this. Now, let me say it again. This is not a recommendation. We're nowhere near the optimal time to buy this. More than likely, if I buy it now, I'm doing what everybody else is doing. I'm just buying because I think something's going. I don't know where it's going. You don't want to trade straddles that way, folks. They're not. When you trade straddles based on something called statistical probability, you will lose way more times than you'll win. You won't get 16 in a row like we did. But if we just go into those inefficiencies are what we trade. It's kind of like, who's seen the movie 21 in here? Who in here has seen the movie 21? Now, when you think about the movie 21, if you've never seen it before, you're thinking about somebody that's 21 years old that now can drink. No, not that movie. I'm talking about 21 Blackjack, right? Where they taught, and you see the movie, you see, and even that, the other one that I like is the Matt Damon one, the poker.
Rounders.
Yes, Rounders.
Great movie. Because
you know what they do? Rounders is really a me versus you, where Blackjack is you against the house. And the takeaway is on 21 is that they went in only when the cards looked good. So they were card counters. You know what we're doing? We're counting cards. We're counting cards here, folks. The only difference is I'm not going to get backroomed if I'm caught. You know what happens if I'm caught? I'll lose a little money, and I won't take that trade again next time it comes around. So here's the straddle. I'm buying it, so I'm going to buy it for $7.50. That's $750 I'm putting out for the straddle. Now, what am I looking for to happen? I'm looking for the price of this call or put to go up. Now, you see what just happened? That 360 dropped down to a 350, but the 390 went up to a 4. So did we have a net effect? No, it's still 750 for the whole thing. I want to see that 750 go to 8, go to 850, etc., because I want to see both the price of the call and the put go up, or I want the call to go up faster than the put goes down, or I want the put to go up faster than the call goes down. In any of those three scenarios, I make money. Now, there is a scenario where both will go down, but they'll trickle. See, look what just happened, Eric. Now we're at 753, so it's gone up a little bit. And so you'll see this go up a little bit in our search strike. That's exactly what's happened. But it hasn't always happened, Eric. It hasn't always happened. Okay?
Nope.
So here's the thing. Sometimes you got to deal with losses. So when I put this in, this order's in, and I could talk about what to look for. And then if I put this in, let's say that I'm looking for 100% return on my straddle. So once I have this in as an open order, I want to set it up to where I'm going to sell to close. All right, a portion or all of my straddle. And if I bought it for 750 and I sold it for 15, what did I just do, Eric? I just doubled
You made
my money.
Yep.
I double my money. If I put out $7.50, I take $7.15 and I just made $7.50. What if I put $7.50 out and I took in 11? That's almost a 50% return. I'm looking for anything north of what I bought it for. Okay. Now, what about losses? Because losses can happen. Losses can happen, folks. All right. So, I mean, we were looking at losses, and Eric, we put an alert out yesterday on a couple of our straddles that were announcing earnings yesterday after the bell. Put that up, and let's have a discussion about that.
Sure. This is the June 6th Operation Surge Strike Alert. Both Coupa Software and GitLab announce earnings today after the bell. This means it's time to exit our straddles on both of these trades today. The stocks haven't moved since we've entered, but IV Surge, the secret sauce of Surge Strike, has kept losses greatly mitigated, leaving the straddles at slight losses currently. Thoughts on that one, Tom?
Right. So, you know what? Let's go take a look at Coop.
Okay.
COUP. And oops, that was not Coop. That was COU and something weird. P. Coupa Software. Okay. Look at what happened. Now, I want to show you something, guys. This is why we get out of these things. Do you see this, how it kind of went up? And it really, I mean, we took a small loss on Coupa Software. And if you take a look, and I'm just going to bring up, an option chain of Coupa. And I just want to show you what the at-the-monies have done between yesterday and today in terms of numbers. So June 10th is our expiration, COUP. And so I'm going to show you, here's June 10th. Here's the straddle right now. Let's call it the 75 straddle. So the at-the-monies. So the at-the-monies are trading for $225 for the call and $298 for the put. So let's just call that $225 and 3. So $5.25 for that straddle. What were they trading for yesterday? Let's go see. So I'm going to bring this back to the 6th, and let's hit go. 75s, 465 and 740. So they were trading for over $12. So it went from $12, Eric, down to like $3.
Yes, it did.
So do you see how we got out of this? We took a loss. But it was a little loss. And you see this? Now, price didn't move. Price didn't move at all. Look what moved. The option volatility got sucked. That you hear that sucking sound, Eric? That's your money going out the door if you hung on to the straddle this morning. So I like to call this Brutus risk versus all-in straddle risk. Brutus risk is we go in and we time it. And you know what happened? It just didn't get up and go anywhere. And that's fine. It's gonna happen. All right. That's exactly what I talked about. Like all of a sudden, the cards didn't flop over the way we wanted them to, but we got out and we went to cash, and then the big drop occurred. Boom. I mean, this thing saw a better than 65% drop in option price between yesterday afternoon and this morning. So I want everybody to just let that sink in. You can do it my way, which is the Brutus way. You get in when you're supposed to get in. You get out before the crowd. Or you can do it their way. And you can see what happened by doing it their way. And that's the thing. It's pre-event entry and pre-event exit. Or you can do it everybody else's way, which is, you might as well go to Vegas. That's fine too. For Operation Surge Strike, guys, we have that strategy. We get in and we get out. It is a pattern, and it works for us in good times and in bad. Okay? So, Eric, how about we look at, you know what? Before I wanted to look at a couple of charts. So let me ask the group real quick. If you guys want to look at a chart or two and see what's happening on the IV side, go ahead and put your stocks in now. I'll have Eric. Eric, you could throw some stocks at me in just a minute, but I want to show everybody something that we're looking at right now. There's a couple of Brutus picks that I'm looking at right now. I'm going to throw those up on the screen. There you go. There's Adobe and Nike are popping up here. All right. Now these aren't ones that we're putting on today. These are coming up in the future. So they're coming up on the first pass. Adobe, Nike, Micron, which we already talked about, CarMax, Oracle, Kroger. Right? Those are on here. Right? And by the way, some of them are calls and some of them are puts. They're ranked because of these numbers over here. Right? These are what we call those average return on investments. And a lot of these look like the high 50s to the mid 40s. Now, I'm going to mention this. Again, this is first pass. First pass means I go through and we optimize these. I optimize these. Mike Wade optimized these. He's Brutus Maximus, okay? And he'll be joining us at 1 o'clock today. And of course, we'll optimize those, and we'll look at what the very best dates are to get in and out. The optimal call, the optimal put, the optimal straddle. All right. Someone asked a question, does Brutus do straddles? Yes, it does. Not the app. The app version is just optimal call and put. You have to use the software version to get the straddles. Okay. But that's what we're seeing right now. We're seeing those stocks that popped up. What stocks are you looking at right now, Eric?
Yeah, let's take a look because it came from Trader Kathy. Let's take a look at BKR to start.
BKR. Okay, so when we're looking at BKR, this is Baker Hughes. So Baker Hughes has earnings in the next 43 days. That's a little past. Brutus looks at earnings no farther out than 30 days in future. So ask me that one again in about 2 weeks, and I think we'll have an answer for you. But just looking at the chart, this was one of those when you're looking at, this is the 60-day chart. Let's go look at the 120. Because I want to take us back to at least where the year started out. And you can see we were down here in the low 20s. So we had this move up that peaked. It came up and peaked up here just before 39. We had a pullback. We stuck the area right between 50 and 61% retracements. We're seeing this coming back up right now. Baker Hughes is coming up to a new high for the year. I like this one to the upside, but I would be a little bit nervous holding this one through earnings if you really were going to be bullish on it. And again, come back and ask me this one in a couple of weeks, and we'll run it through Brutus, and we'll see if Brutus likes it optimally to the upside. And judging on what I see on this chart, I think that might be the answer, is this one might be a good call option trade to the upside, getting closer to its earnings. Eric, what else you got?
How about TGT? It's coming from Hot Pepper.
TGT. Hot Pepper? Woo! Man, look at this mess. And I'll let you know this. I actually was looking at calendar spread. I actually did a calendar spread on Target when it dropped down like this really hard. And it actually worked out pretty well for me. But here we are now. We're coming down, and we're hitting those lows once again. I might want to look into that potentially again as a sideways or bearish strategy. I think looking at it, you want to be short for short. You want to be long for long. That means that if you're going to be short, it's for a short term. If you're going to be long, if you're going to think about Target long term, they're going to fix this mess. They have to. Okay. They are Target. They are Walmart times 2. And so I believe they will fix this mess, but they're running into a lot of issues. They're not the lowest price leader. They are dealing with supply chain issues. They are dealing with having to reshuffle the deck on the retail shelves. And so, but I do think they'll get through this. But short term, you can still see they've got a lot to cover. Volatility is right in the middle. All right, volatility's been on the high side with their earnings, both the earnings that occurred back in February and the ones that occurred again last month. As you can see, that big drop down here. Long term, I think it's a great buying opportunity. Short term, I don't have anything right now other than staying in this sideways range. All right, one more, Eric.
One more. How about one that we all know, UVXY?
UVXY. Okay, so this is going to be that long-term volatility. And this is, the Ultra VIX short term. Ultra VIX short term, my bad. So when you look at Ultra VIX short term, this is a pro shares. I'm not a big fan of pro shares and hanging on to them for any length of time because they've got all this contango built into them and management fees. Keep that in mind if you're a buyer of these kind of things. I like them short term. And if I'm going to hold on to something like this, I like it short for the short term, meaning I like to trade it to the downside. You can see that's been really the last month where this is all the action's been, as it's gone from 20 down to right around 13. We had a pop this morning, but as the markets have come back, volatility is dropping down. Again, if you're trying to trade this into Fed watch, then you're definitely a trader of UVXY. Okay, but I don't like to be a long-term buyer of this unless I'm spreading it with something like a butterfly spread, where I'm spreading across different strikes and I'm really cutting in as hard as I can into my cost and my risk. So, all right, guys, I showed you, let's do a recap here. So we looked at stocks, bonds, currencies, commodities. We looked at some of the Brutus stocks and what I'm looking at for what I like to call the first pass. All right, we looked at first pass Brutus stocks. And my favorite trigger trade setup right now, Mike is going to be talking with everybody at 1 o'clock. And we're going to be looking at those two straddle trigger trade setups. Again, if we decide to act on one or both of these, we will let you know via alerts, trade alerts, email, and or text. So those of you that are part of Operation Surge Strike, you know what? Go grab a quick sandwich. Go grab something to eat, something to drink. Come on back. We will be in our members only room, and we'll talk about what those two trigger trades are. And so other than that, folks, tomorrow. So tomorrow I'm going to be back here at 11:30. We're going to do a little bit of the same, but what I want to do is I want to talk about momentum and I want to talk about quantum. All right. We ran 10-0 on quantum. We took a loss. Okay. We've got a mixture. We've got more profits than we have losses on quantum right now. I want to talk a little bit about the quantum strategy. And I want to look at something I talked about just yesterday. We're starting to see scans on quantum. Eric, we're starting to see scans that are starting to show bullishness of anything. We're seeing bullish call opportunities. I want to talk about what some of those stocks might look like. We'll do that tomorrow. For those of you that are going to be with us here in a half an hour, come on back at 1 o'clock. We'll do a deep dive on Operation Surge Strike. For those of you that won't, I'll see you tomorrow. Garrett's up next. Peace out. See you then.